The day you retire, most people think they are leaving work. What they are really leaving is automation. That is the first thing I would want burned into your mind. When you had a job, the tax system protected you from your own neglect. Not because the government loved you, not because the system was elegant, because your employer did the ugly work before you ever saw the money. Taxes were taken out, withholding happened, Medicare was handled, Social Security was handled. April might still sting, but most of the machinery had already been running in the background. Then one day the paycheck stops. And people call that freedom. I do not. I call it transfer of responsibility. And if you do not understand that transfer, retirement will look peaceful on the outside and leak money on the inside. That is how the IRS gets people. Not with some cinematic raid, not with a dramatic confrontation, with silence, with forms. You never filed with deadlines you did not know existed, with thresholds that were frozen decades ago. With one extra IRA withdrawal that turns one harmless decision into 3 separate taxes and a Medicare surcharge. Most retirees do not get ruined by one giant mistake. They get shaved to death by 10 quiet ones. That is the real story in the document you gave me. It is not a tax checklist. It is a survival manual for the moment your life stops running on payroll autopilot and starts running on your judgment. And judgment, I have learned, is where most people discover they were relying on habit far more than understanding. So let me tell you the truth in the clearest language I know. Retirement is not the moment taxes become smaller. Retirement is the moment taxes become personal. That is the master line. When the paycheck disappears, your tax life stops being industrial and becomes architectural. You are no longer stepping inside a system built by an employer. You are now building your own system from income streams, withdrawal timing, withholding choices, conversion windows, Medicare thresholds, and a government that will never once call you to warn you that you are drifting into a trap. That is why I want to tell this story as Warren Buffett, not as an accountant. Because the deepest mistake here is not mathematical, it is psychological. People walk into retirement with an employee mind. They need an owner mind. Employees ask, how much do I get? Owners ask, what system is producing the cash, what taxes attached to it, and what chain reaction starts if I touch this lever instead of that one. That difference is worth thousands of dollars. A year, sometimes tens of thousands, sometimes more. Let me frame it with the metaphor that matters. I call it the cockpit switch. When you were working, you were sitting in the cabin. The tax system hummed beneath the floorboards. You did not need to understand every gauge, because somebody else was in the cockpit. Withholding, payroll tax, employer reporting, defaults, all of it happened out front. The moment you retire, the cabin door opens and someone points at the pilot seat. Now it is your cockpit. Now you decide what gets withheld. Now you decide when to pull from the IRA. Now you decide whether Social Security gets taxed. Now you decide whether a Roth conversion saves money or detonates Medicare premiums 2 years from now. Now you decide whether you itemize or take the standard deduction. Now you decide whether the IRS penalty gets waived or quietly paid because you never knew the waiver existed. That is retirement, not rest responsibility. And if you do not like responsibility, the IRS will tax your confusion. The first mechanism I want you to understand is what I call withholding vacuum. A job creates tax friction before the money reaches you. Retirement removes that friction and replaces it with discretion. That sounds pleasant. It is not. It is dangerous. People see pension income, IRA withdrawals, Social Security, dividends, rental income, and maybe a little side income. And they think the money is coming in, so the system must still be working. But the system is no longer working by default. It is waiting for you to tell it what to do. That is why estimated tax payments matter so much. Most retirees have no emotional relationship with quarterly estimates because they never had to. The employer absorbed the habit for them. Then retirement arrives. The automatic withholding is too light or missing entirely. And by the time April shows up, the retiree is not just short on tax. He is short on tax plus penalty. That penalty offends me more than most taxes because it is often collected from people who were not cheating. They were simply operating on the outdated assumption that the old machine was still running. The source document explains the safe harbor rule, the quarterly deadlines, and the rates. Good. But the deeper truth is simpler. If you retire and do not deliberately rebuild withholding, the IRS assumes you chose exposure. Government is very good at mistaking ignorance for intent. And that is why the first protocol in retirement is not investment return. It is tax flow reconstruction. If you do not reconstruct the flow, you are flying blind. The second mechanism is Social Security drift. This is one of those areas where retirees get ambushed by language. They hear Social Security and think social insurance. They think safety. They think baseline income. They think after a lifetime of paying into the system, the check that arrives should at least be straightforward. It is not, because the tax code does something so deceptive here that I almost admire the cynicism of it. It does not simply ask whether you receive Social Security. It asks what else you are doing around it. That is the provisional income formula. A person can feel modestly situated and still cross the thresholds that tax more of the benefit. The thresholds themselves are ancient. They were set decades ago and then left there to do what unindexed thresholds always do. Over time, they catch more people, not because people got rich, but because the nominal world inflated while the law stood still. That is how the trap matures. You bring in one more dollar from an IRA, one more dividend, one more capital gain, one more slice of income you thought was isolated, and suddenly it does not just get taxed on its own. It drags more of your Social Security into the taxable zone too. This is the part most retirees never see coming. They think in straight lines. The IRS thinks in chain reactions. That is why I named the third mechanism benefit cascade. Benefit cascade means a single income decision changes 3 or 4 other outcomes you were not watching. You take a bigger withdrawal. More of Social Security becomes taxable. Adjusted income rises. Medicare surcharges get closer. Maybe a deduction phase-out begins. Maybe the following year becomes more expensive, even though the money was already spent. This is not ordinary taxation. This is trapdoor taxation. The floor looks flat until you step on the wrong board. That is why filing Form W-4V to withhold from Social Security is not some clerical footnote. It is part of re-engineering the income machine, so the surprise bill does not arrive after the money has already been consumed. I have always believed that the best tax plan is one that prevents panic before panic becomes necessary. The third major mechanism is the bracket window. Most people think of tax brackets as fixed categories. I do not. I think of them as temporary real estate. Sometimes you should stay inside one, sometimes you should fill one deliberately, sometimes you should avoid crossing into the next with the discipline of a man tiptoeing around dynamite. Retirement creates years that look quiet on paper and are incredibly valuable in reality. The source calls them the gap years. I call them the cheap years. Not because life is cheap, because taxes can be. This is the period after work ends, but before required minimum distributions begin. And often before Social Security fully stacks on top of everything. Income may be lower, the bracket may be softer. The temptation is to enjoy the quiet. That is exactly when I want a thinking person to plan. Because once RMDs begin, the government stops politely waiting for you to decide when to recognize income. It decides for you. And when it decides for you, it rarely does so with any concern for elegance. That is why Roth conversions during the quiet years can be so powerful. A lot of people talk about Roth conversions like they are a product. They are not. They are a timing weapon. You are deciding to pay known tax now in exchange for reducing future mandatory income, future bracket pressure, future Social Security taxation, and future Medicare premium pain. The beauty of this in a down market is even greater. If the market is temporarily bruised and you convert, then you are moving more future recovery into a tax-free shell while paying tax on a temporarily depressed value. That is not just tax planning, that is opportunistic tax engineering, and good owners engineer employees react. That is the identity flip. If you walk into retirement and keep reacting, the IRS will lead the dance. If you engineer, you start taking back the timing. Now let me give you the fourth mechanism. RMD compression. People hear required minimum distribution and think rule. I hear compression because that is what it does. It compresses optionality. You may have been able to choose distributions elegantly for years. Once RMD age hits, a portion of the decision is no longer yours. The government wants the tax revenue, and it wants it now. The source gives the age, the deadlines, the penalties, and the caution about taking the first distribution by the 1st of April of the following year. Good. But here is the more vivid way to see it. When you delay that first RMD into the following year, you create a tax traffic jam, 2 distributions in 1 calendar year, 2 streams of ordinary income landing on top of each other. And because retirement tax problems travel in packs, that does not just threaten a bracket. It can make more Social Security taxable and push Medicare premiums higher as well. That is why a rule on one page becomes an ambush across 3 systems. RMD compression is what happens when delayed action reduces future room. I dislike compression in all things. Financial compressed choices are expensive choices. And that is why the smart retiree starts planning years before the RMD line arrives, not months after it has already crossed. The fifth mechanism is what I call Medicare echo. Most people think health costs respond to this year's behavior. Often they respond to what you did 2 years ago, that is IRMA, and it is one of the ugliest little delayed explosions in retirement. You make one large withdrawal, one large conversion, one lumpy capital gain, and you feel fine because you can afford it. Then later, Medicare comes back and says your premiums are now higher because of your income from 2 years prior. That lag is what makes it so treacherous. Delayed pain is always underestimated. People think a decision is over when the cash settles. In retirement, that is often when the echo begins. This is why I always tell people not to measure the cost of an income decision only by the tax you pay today. Measure the echo, what changes next, what gets dragged across a threshold, what premium resets, what benefit gets squeezed, what invisible formula wakes up. This is the difference between arithmetic and wisdom. Arithmetic tells you the immediate tax, wisdom traces the aftershocks. Now let me talk about the senior bonus deduction, the standard deduction, and the SALT cap change, because buried in these is one of my favorite lessons. The government often changes the rules faster than people change their habits. That is where money leaks. People form filing habits when one regime is in place and keep acting as if nothing changed. They keep using the standard deduction because that became the right answer years ago. Then limits move, deductions change. Bonus provisions appear, or the arithmetic turns the other way, and they never bother to rerun the numbers. That is not frugality. That is laziness wearing reading glasses. The source document correctly points out that many retirees have much larger deduction shields available than they realize, especially when the senior add-ons and temporary bonus deduction are combined. For some, the standard deduction will be an obvious winner. For others in high-tax states, itemizing may become more attractive again. Once the SALT cap changes, the point is not which outcome wins in the abstract. The point is that autopilot is the enemy. When the tax environment changes and your method does not, you start donating money by habit, and habit is the most socially acceptable way people go broke. Now I want to pull the 10 expectations in the source into one operating system. Because if I just leave them as a list, you will respect them and forget them. I want them organized into a frame your mind can actually use. I call it the retirement tax operating system. It has 5 commands. Command 1, rebuild withholding. That includes estimated payments, withholding on Social Security, and understanding that retirement income streams do not self-regulate the way payroll did. Command 2, map the triggers. That means provisional income, RMD timing, IRMA thresholds, and the exact points where one innocent decision mutates into multiple tax consequences. Command 3, exploit the cheap years. That means Roth conversions during the gap years, doing work when your bracket is low, and using down markets intelligently. Instead of emotionally, Command 4, reduce taxable drag where the law permits. That means using QCDs when charitable giving is already part of your life, claiming deductions you actually qualify for, and not lazily assuming the same deduction choice still makes sense every year. Command 5, respond to every signal. That means updating your address, opening every IRS letter, understanding the notice type, acting before deadlines expire, and never putting official paper in a drawer because you do not like the feeling it gives you. That is the system. If you follow it, you stop being the person the IRS profits from by default. And there are a lot of those people. What offends me most about retirement taxation is not that it is complicated. Complexity is common. What offends me is that the people most vulnerable to it are often the people who spent decades doing the right things. They worked, they saved, they paid off debt, they delayed gratification. Then they reach retirement and find out that the financial machine they trusted has now become manual, full of hidden levers, and staffed by nobody who feels obligated to explain the controls. The system does not call you on your last day of work and say, from now on you must think quarterly. It does not say, your Social Security may now be partially taxable, depending on a formula you have never heard of. It does not say, the quiet years before required distributions are the most valuable tax years you may ever have. It does not say, one extra withdrawal can cost you now and again later. It does not say, you may be paying an underpayment penalty and not know that a senior waiver exists unless you ask for it properly. It simply waits. And then it charges. That is why I want the tone of this story to stay hard, because softness is what creates tax victims. People need a mild jolt here. Retirement is not when you stop planning. Retirement is when planning finally starts to matter. Let me give you one stronger identity flip. The person who retires successfully is not the person with the highest account balance. It is the person who learns how to turn withdrawals, withholding, conversion timing, benefit taxation, Medicare thresholds, charitable flows, and deduction choices into one coordinated machine. That is wealth, not money alone control, because money without control gets skimmed every time. Now, I know some people will hear all of this and feel exhausted. Good exhaustion is honest, better to feel tired now than ambushed later. This is exactly why most people miss all 10 of the IRS expectations described in the source. None of them feel like a big dramatic event. They feel administrative, small, delayable, something you can handle after vacation, something you can ask the preparer about next year, something you can just deal with when the letter comes. That mentality is poison, because retirement tax mistakes do not accumulate in a straight line. They stack. A missed estimate becomes a penalty. A bad withdrawal year makes more benefits taxable. More taxable income raises future Medicare costs. An ignored RMD becomes a penalty. No address update means an IRS notice misses you. A missed deadline means you lose the right to contest or fix on favorable terms. That is the stack, and stacks collapse faster than lines. If I were talking to a newly retired person over dinner, I would tell them there are only two ways to enter retirement. Either you retire like a passenger or you retire like a pilot. Passengers say, "I hope this works." Pilots run checklists. Passengers assume somebody is watching. Pilots confirm who is responsible for what. Passengers wait for the warning light. Pilots make sure the fuel is there before takeoff. That is the mentality difference. And in tax matters, mentality is everything. The IRS does not need you to be reckless. It only needs you to be passive. That is why the opening line of the source is so powerful. When you had a job, taxes were simple because the system handled itself. The moment you retire, that entire system stops, and nobody explains what replaces it. I will explain what replaces it. You do. You replace it. Your discipline replaces it. Your calendar replaces it. Your withholding elections replace it. Your quarterly estimates replace it. Your bracket planning replaces it. Your conversion strategy replaces it. Your notice handling replaces it. That is the truth. Retirement is not the absence of a system. It is the transfer of system ownership. And if you still behave like the system belongs to somebody else, you will spend the first years of retirement paying tuition to learn what you should have known before the first check even arrived. So here is the knife. Edge ending. I want to leave you with: the paycheck stopping is not the danger. The illusion that the tax machinery kept running after it stopped, that is the danger. That is how retirees lose money. They never needed to lose. Not because they were foolish, because they were still living like employees in a world that now taxes owners, and the IRS is very good at telling the difference.